All right, Glitch the Matrix 1, life insurance. Listen, look, I'm going to get right into this because y'all have been patient. Although term life insurance provides only pure death benefit protection, permanent or whole life insurance is a different story. Permanent life insurance policies provide death benefit coverage plus a cash value component that can allow the policyholder to build up in a substantial amount of tax-deferred savings over time. As tax-deferred growth goes, life insurance policies, typically, specifically whole life insurance policies, are cold business. Now, what do I mean by glitch the matrix? Glitch the matrix is the matrix is set up, and then when I say the matrix, I'm talking about the commercial system, the commercial system. So the commercial matrix, the commercial system. I don't mean matrix like the movie. You can look up the term matrix and understand what that means. But when I'm talking about glitching the matrix, I'm talking about glitching the commercial system. Now, first and foremost, we're taught to believe that in this commercial system, it's all about how much money that we make. How much money you make. You big baller, you flashing, you got your dance, whatever. It's not about how much money you make. It's truly not. It's about how much money you keep. And one of the ways to glitch the matrix is to not concern yourself with how much money you make, but actually concern yourself with how much money you keep. If you are mature of mind and adolescence and you are truly about your family, you're not really worried about how much you make. You're worried about how much you keep, because how much you keep directly translates to the assets of your private estate, as well as the quality of life that those within your family are allowed to experience. Quality of life is: do we take the bus? Do we have a car? Do we fly commercial? Do we fly business? Do we fly first class? Do we fly private? Do we go to islands? Do we not? Quality of life. What are you doing? What type of lifestyle are you living? Now, when it comes to the matrix is built and set up to keep us on the bottom, hands down. If you don't understand that, if you can't see that, you got to do more studying. I don't want to get into that in this episode of The Foundation. I just want to talk about this glitch. And this glitch in the matrix is tax-deferred growth of income in a specific type of contract. Yes, I said contract. You know me. I'm so L. I love this private dance. I'm all about going private. Trustee training. Admin at welcometothefoundation.com. But when it comes to this contract has been around for a long time. It's called a life insurance contract. And if you understand what you're doing, if you understand how to do the dance, this is one of the first ways, once we're private, that we use to glitch the matrix. And when I say glitch the matrix, modify how much we're actually keeping, modify how much our estate is actually able to keep versus how much income or wealth comes into the estate. It's all about what you keep. I don't give a flying whatever dance about what you make. That doesn't matter to me. It does not. So, with that being said, tax-free dividends. With permanent life insurance policies such as whole life insurance, the gain in cash value is not taxed until it is withdrawn. This means that funds are essentially able to obtain gains on top of gains on top of gains on top of gains, year after year, allowing the money to grow substantially over time. When the policyholder does not make a withdrawal, the gains are taxed as ordinary income. If you don't harvest the cash value before death, however, you risk the chance of the cash value, including the policy's dividends, will be absorbed by the insurance company, and only the death benefit will be paid out to the beneficiary. In many cases, dividends received on eligible life insurance policies are also tax-free and do not have to be reported on the policy holder's tax return. This is because dividends are considered a return of policy premiums. It is important to note, though, that dividends could become taxable if they start to exceed the net amount of premium that has been paid into the policy, and this is known as a modified endowment contract, or a MEC. A modified endowment contract is a cash value life insurance contract where the premiums paid have exceeded the amount allowed to keep the full tax treatment of a cash value life insurance policy. In a modified endowment contract, distributions of cash value are taken from taxable gains first, as compared to distributions taken from non-taxable contributions. In other words, withdrawals will typically be taxed as ordinary income instead of treated as non-taxable income. And this is what you have to avoid when glitching the matrix with life insurance policies. This is not legal advice. This is not legal advice, man. Upon the death of the insured, the cash value, including the policy's dividends, is absorbed by the blah, 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 blah. I said that right. Cash withdrawals. You can take cash back out of the policy if it has sufficient cash value. A withdrawal will generally be tax-free up to the amount of the policyholder's basis in the plan. This basis amount of money is basically all the premiums that have been paid via the payments. Any amount above the basis is considered to be a gain. The gain is subject to ordinary income tax on withdrawal. Withdrawals are typically treated as coming out of the policy's basis first and then the gain. In order to access cash withdrawal, it is typically necessary to contact the insurance company directly. In a cash surrender, you simultaneously take out the cash value and cancel your policy. But I wouldn't do that. That is ridiculous. Policy loans. The cash value in a permanent life insurance policy may also be used as security for a policy loan. As long as you repay the loan, you are not wiping out the coverage provided by the policy because you're only working with cash value. When a policyholder borrows against the cash value in a permanent policy, it is not considered a distribution and it is not counted as income. It is not counted as income. It is not counted as income. So if you have one of these life insurance policies, and I'm just going to let you know, man, y'all need to download this, rewind this, do what you got to do what you got to do. So a policy holder paying the premiums of a life insurance policy, let's say those premiums are $10,000 a year. Paying those premiums to a life insurance policy, there is a tax benefit for paying policy premiums. And then that policy holder can turn around and take that money back as a loan. I don't care how much money you make. It matters how much you keep. Control everything, own nothing. There are no taxes due on life insurance policy loans and no surrender charges because the policyholder is not technically withdrawing any money. Death benefits. Policy death benefits are usually paid to beneficiaries. Income tax free. Internal Revenue Code Section 101A. Tax free death benefits. Benefits paid out before the insured's death because of chronic or terminal illness are tax free. Internal Revenue Code Section 101G1. Policy cash values. Cash values can grow within the policy without being subject to tax. Internal Revenue Code Section 72. Withdrawals up to the amount of the policy owner's tax basis are not subject to income tax. So you putting it in there tax-free, you can withdraw it tax-free. Internal Revenue Code Section 72. Cash values exceeding the owner's tax basis may be borrowed from the policy income tax-free as long as the policy stays in force. Internal Revenue Code Section 72 and 7702. The owner may exchange an existing policy for a new one free of income taxes. Internal Revenue Code Section 1035. 1035 exchange, y'all. The owner may exchange a life insurance policy for an annuity free of income taxes. Internal Revenue Code Section 1035. Life insurance policies transfer wealth to beneficiaries through the death benefits paid out when an insured dies. Over the years, Congress created the federal, state, gift, and generation skipping transfer tax to the Internal Revenue Code to tax and regulate the transfer of wealth. Each of these taxes gives insured opportunities for life insurance to pass on wealth to family members with favorable results. Death benefits paid to surviving spouse who is a U.S. citizen qualify for marital deduction and aren't taxed. Internal Revenue Code Section 2056. Death benefits payable to others aren't part of the taxable estate if the insured did not have an incident of ownership in the policy at any time within 3 years before the death. Internal Revenue Code Sections 2042 and 2035. Gift taxes. Premiums paid by the policy owner aren't treated as taxable gifts. Funds an insured gives to someone else who owns the policy can avoid gift taxes if they qualify for the gift tax annual exclusion or the lifetime gift tax exemption. I know I'm going fast. I suggest you download this. The cash value of your whole life insurance policy will not be taxed while it's growing. This is known as tax deferred, and it means that your money grows faster because it's not being reduced by taxes each year. This means the interest you make on your cash value is applied to a higher amount. It also likely that your earning power during your prime working years will put you into a higher income bracket, meaning you're paying a higher percentage of your income in taxes. Later in life, when you're no longer bringing home a regular paycheck, your income and your tax bracket could be lower. So if you withdraw your money when you're in a lower tax bracket, it will get taxed less than if you first applied it to your account. Whole life insurance is a robust, permanent type of insurance that doesn't simply vanish once a time frame is over, unlike the basic term life insurance that many people buy, and your cash value can help create a significant asset. Interest and dividend payments from the insurance company can build up your cash value. Annual dividends are never guaranteed, but some mutual life insurance companies pay them out year after year. Another factor is taxes. In general, the interest build-up portion of your annual increase in the policy's cash value is not taxed annually. Another life insurance tax benefit kicks in if you decide to borrow against your cash value, although this type of loan is not treated as taxable income. It will have interest charged by the insurance company until you pay it back, but the interest that is charged is added to the cash value of your policy. You can also choose not to pay the loan back, although this would affect the amount of your life insurance payout to the beneficiaries. The third major life insurance tax benefit affects the money your beneficiaries will receive after you pass away. This is normally untaxed and is generally quicker for them to receive than things like property and other assets, while an estate has to go through probate. Even if you leave a will, that can take several months. A public estate has to go through probate. Life insurance policy payout will get to your beneficiaries typically within weeks. The death benefit itself is income tax free. Any earnings accumulated in your insurance policy's cash value grow free from taxes. The death benefit of your permanent life insurance is generally passed on to your beneficiaries free of federal income tax. Premium withdrawals may be tax-free. Transfers among underlying investment options of a variable life insurance policy are generally not subject to current income or capital gains. I'm telling y'all, this is how we glitch the matrix. BankingTruth.com, famous entrepreneurs who used whole life insurance as their bank. Would you believe that Magic Kingdom of Walt Disney would not exist if Walt didn't have a well-funded whole life insurance policy? Walt Disney's whole life policy acted as his own personal bank to provide the necessary liquidity to fund his dream. At the time, it was a vision that only he could see, but one that the masses from around the globe would someday enjoy. There are countless other stories of famous entrepreneurs who have essentially used the cash value in their life insurance policies to help with these three common phases of business. Part 1, starting their business, growing their business, or saving their business. Walt was trying to start a business, but had a very difficult time getting banks to partake in the vision of cartoon mouse and duck that would bring in masses from around the world. The Disneyland source book quotes, "I could never convince financiers that Disneyland was feasible because dreams offer too little collateral." Thankfully, he had previously built his own bank using whole life insurance. Unfettered, borrowed against his life insurance and sold his second house just so he could develop his idea to the point where he could show others what he had in mind. Studio employees worked on the project paid from Walt Disney's personal funds. Because Walt Disney had his guaranteed access to liquidity, he was able to eventually capitalize on his dream and create a multinational empire for generations to enjoy. If you saw the movie The Founder, starring Michael Keaton, you know that his success didn't happen overnight. It's documenting that Ray Kroc borrowed against 2 different cash value life insurance policies to pay his key employees along the way. He also funded McDonald's Hallmark branding campaign using the precious liquidity provided by his whole life insurance policy. Ronald McDonald was born because Ray Kroc was able to acquire funds at any time for any reason from his own private family bank. J.C. Penney had his chain of department stores on autopilot and cash flowing nicely during the boom and roaring 20s. It was a quintessential American dream fulfilled, like most business owners at the stage of prosperity. Mr. James Cash Penney diversified into a vast stock portfolio as well as acres upon acres of Florida real estate. He also bought life insurance. Regardless of why he bought it, his whole life insurance policy quickly became his favorite asset class after the stock market crashed in 1929. The Great Depression ensued. Real estate tanked, especially overvalued Florida real estate. Banks failed by the dozens as masses came in demanding their deposits back. However, there was much stricter reserve requirements placed upon life insurance companies than on banks. Many of the prominent life insurance companies at the time actually participated in bailing out the banking industry. These ultra-conservative life insurance companies were therefore in a very enviable position in terms of liquidity, and so were their whole life insurance policy holders. Thanks to the contractual growth and guaranteed liquidity inherent in whole life insurance policy, you could say that life insurance companies also bailed out J.C. Penney during the Great Depression. Around the same time that the crash hit, James Cash Penney's health was starting to give way, probably due to the stress of the situation. How reassuring it must have been for J.C. to know that even though he took a large loan against his cash value to save his business, there would still be a substantial death benefit paid out to his family if he were to pass away during the tumultuous time. Telling y'all, 5 businesses saved by cash value in life insurance. What are these businesses? J.C. Penney, 1929. Foster Farms. Max and Verda Foster borrowed $1,000 against their life insurance policy to invest in an 80-acre chicken farm. Today, Foster Farms products are sold all over the world. 1939. 1955, Disneyland. 1961, McDonald's. 1980, Pampered Chef. Doris Christopher used a policy loan of $3,000 to start her kitchenware company. The company was later purchased by Warren Buffett's Berkshire Hathaway for $1.5 billion. I'm telling y'all straight up, I ain't playing no games. I'm not telling you to sign up for an email list first or nothing. I'm telling you, this is how the wealthy and those who are informed glitch the matrix. Main thing, life insurance policy. Is the only thing that's guaranteed in this life for sure is death. And this is the only contract that I know of on the planet that pays the beneficiary beneficiaries when someone dies. You imagine that? Plus, there's cash value to boot. You become your own bank. But I'm not going to get into private family bank. We still talking about life insurance now. For those of you who stuck around, we got about 60 seconds left in the broadcast. You're going to want to call in 424-222-5250. You will be cut off very soon. You're going to miss this. I'm about to drop some more jewels. How this applies to those of us that are private. How does this apply to those in trustee training? I know a lot of trustees listen to the show. Specifically, when you're dealing with trust and trust administration, you got to understand the trust takes its allowable expenses as deductions according to the trust indenture. The trust that we use, they're not governed or controlled by state statute in any way, shape, or form. So the trusts take their allowable expenses according to the trust indenture, and anything else that's left over is up for taxation. I'm going to say it again. Private contractual trusts are able to take a deduction for their allowable expenses, ordinary and necessary expenses, according to the trust indenture. Now, a lot of times, if you study corporations, you're going to come across, especially if you study corporate wealth, you're going to come across these whole life insurance policies. And you're going to come across what is known as key man, K-E-Y, like a key lime or a key in a lock, key man insurance. And these insurance policies are on executives typically, high-level executives of corporations and high-level administrators, those executives and administrators who, if anything happened to them, the corporation will be irreparably damaged. They'd have to find someone else to take that place. It's a highly skilled person who's occupying these positions. So the corporations take out what is known as key man insurance, is how it's coded in, how they do their finances, but it's ultimately whole life insurance policies with cash value. The owner of this key man insurance is the corporation itself. If anything happens to this person that is insured, the corporation gets the death benefit, not the family. And you'll see in a lot of corporate documents with regards to executive and high-level administrators, they'll have a clause in there where they have to sign and agree to allow insurance to be put on them in the name of the company. And they got to agree that these particular policies, the beneficiaries will not be them or their family members. And this is typical. This is very normal. Very, very normal. And now this premium on this insurance has now become an expense to the corporation. And corporations, as well as trusts, pay their expenses first. Disbursements and distributions. And what's ever left over is up for taxation at the corporate rate or the trust rate. Now, private contractual trusts, those in trustee training, are allowed to disburse 100% of its taxable income. So anything left after allowable expenses and necessary expenses are allowed to disburse 100% of their taxable income to its beneficiary and therefore have no tax implication. Corporations do something very similar. Most corporations, they don't pay taxes, they pay their expenses, and they distribute their taxable income to the shareholders, and the shareholders have to report that income on their taxes. Now, it depends on how you're holding the shares. Is it personal, through a trust, or a corporation? And it depends. And that's why you hear corporations don't pay taxes. If you're administering an LLC or a corporation, anything like that, and you're paying taxes with that corporation, you're doing it wrong. But yet this is used in the public to foment anger. They're not paying their fair share of taxes. You need to understand these entities, how they're set up, and that the Supreme Court says there is no duty for a citizen to pay taxes or to increase one's taxes. Now, privately, the owner of these policies, these key man policies, would essentially be the family trust. If your family estate has within it a private family foundation that is IRS Form 990-PF, IRS Form 990-PF, if your family has a private family foundation, it would probably make sense to put at least a policy or two on one of the trustees or the trustees of the private family foundation as key man. Now, these policies and the premiums now become expenses to the private family foundation, which is tax exempt, or the private family trust. Now, the beneficiary of the policies would also be the entity, the trust. Just like in the corporate world, the key man insurance, the owner and the beneficiary is the corporation. Same thing with the trust. In the private or the private family foundation, the owner and the beneficiary is the trust or foundation. Reunification. So this is a reunification tool in addition to setting up your private family estate. Individual beneficiaries are not going to get their piece, and even though it's still tax-free, and run off and do their own thing. No, the beneficial distribution from the death benefit of that life insurance policy, is going straight to the family trust. The family members must execute the contract indenture to not only control but benefit from that cash value from that death benefit, and it must be for the benefit of the family trust, which is an additional reunification tool on top of privately setting up your private estate anyways. This is a glitch to the matrix. I'm not playing. The premiums to the policy, the premiums paid to the policy are an expense which reduces the taxable income, if any, to the entity, and you're able to borrow against the cash value. So you paid the money in premiums, but then you got it right back because you borrowed it, and the interest that is paid on the loan goes into the cash value of the policy, so that builds the policy up too. This incentivizes taking loans on the policy and paying them back. You don't have to pay the loans back. You got a death benefit of $250,000, $500,000. You take out a loan worth $100,000, so $500,000 minus $100,000, so the death benefit will be $400,000. As long as the owner of the policy pays the interest on the loans, typically annually, it's cool. It's all good. And there's more that goes into this. I suggest that you get into private trustee training. Email me, admin@welcometothefoundation.com, because there's more than just setting up your trust and getting your 9-8 number with regards to being private. There's implications with regards to generational wealth. There's implications with regards to assets and the private holding of assets and the private control of these assets through these entities. There's implications with regards to doing business, bank accounts, all types of minimum contacts, so many benefits when you get into trustee training and you establish your private estate for yourself, your children, and your future generations, because this is a noble cause, and you will be helped and guided by your ancestors. And if not, then you don't have the right intention or the right heart with it. But those who are responsible, those who are noble, those who govern themselves, and those who look to be accountable and look to be productive to their estate and their family are rewarded. And the family is rewarded. And this is Glitch the Matrix 1. I'm going to do at least, I don't know how many of these I'm going to do. There's a lot, though. But life insurance is just one, and it makes a lot of sense when you get the right policy. It makes more sense when you title the policy properly, when the beneficiaries of the policy are specific and private, and you understand how to administer your system of interrelating trusts. So, like I said, when we started this, I don't care how much you make. It doesn't matter. It doesn't impress me. Yippee skippy. I'm concerned with how much you keep, and that's my main focus with regards to trustee training. So admin at welcometothefoundation.com. This along with a lot of other things you're going to learn in trustee training. You're going to learn in your private instruction. You're going to learn in your private mentorship. Let's say what it is. These are things that I do. These are things that I actively do. I don't talk about. I don't teach anything that I'm not specifically familiar with. I've been administering my private estate with life insurance policy for several years, and it has absolutely helped change the quality of life of my entire family. It's also showed me that through proper structure and administration, we can reduce the estate taxes to zero or very near zero and still control and keep more of the energy, more of the money, more of the value within the estate, and have less taxation, involuntary taxation, erode the wealth of our family estate. There are wealth eroding factors, and trustee training will teach you how to high step all of them joints. So with that being said, I definitely appreciate y'all checking out the show. Let me check this out. We got any callers? Is this thing tripping? I was just, I just did I did a search, tax benefits of whole life insurance or tax benefits of life insurance. This stuff is easy to come up with. Modified endowment contract, MEC. That's if you do too many contributions. It's look what you're looking to avoid. Personally, here at the foundation, we have someone that we deal with specifically with regards to setting up these policies. That's this person, very good friend of mine, and him and his family is structured the same way my family is structured. So he uses the policies and teaches how to use the policies with regards to private estates and private contractual trusts. So, this is not a game. It's not a joke. I done pancaked a lot of toes with this show. A lot of people charging a lot of money to be teaching you this. But whatever. It's the edgy information. It's time for us to step our game up. And the mission of the foundation, one of the main purposes or verticals of the foundation is to raise, our awareness and our knowledge so that we can do business with each other. Because I'm looking to do business with people who look like me. We're looking to do business with people who look like us. So, we got to share some stuff, And, not everything is, something that you could put a dollar value to. And, what this information can do for us, for the listeners of the foundation, for those of us who are followers of high frequency. For those of us who are just looking away so that we can better ourselves, better our lives, better our family, better our, financial situation. We need to understand how to look, man. I'm putting it out there. Admin at welcometothefoundation.com. I'm not going to the phone lines. I see y'all, man. I love y'all. Peace. I'm not going to the phone lines. As far as from current events to the show topic, I really did my dance. Hey, and if you don't think so, let me know. You know what I'm saying? Admin at welcome to the foundation. Tell me, the show was whack. I ain't learned nothing. you're garbage, you're a loser, you should stop. I'm going to laugh at you. You know what I'm saying? Respect your opinion and keep it moving. I'm doing my dance. And you can do your dance too. But this is, multi-generational wealth. Not everything that we set up, not everything that I set up am I going to be able to partake in. Not everything that I establish am I going to be able to experience. But just knowing that my future generations will be able to, and aren't going to have to go through the things I go through, and might be spoiled and stuff and just be them weird little rich kids. But they won't be able to tear it up or won't be able to mess it up or tear it down what I built, because I built it correctly and I built it solid with a solid foundation. You know what I'm saying? So with that being said, admin at welcometothefoundation.com, I suggest you jump in trustee training. Straight up. Take part of this wealth transfer. It's going down. There's going to be more rounds of stimulus. If you didn't set up your LLC, you didn't get it right, there's going to be another round. So you should be setting up your LLC and getting it right. At the very least, if you're not jumping in trustee training, admin at welcometothefoundation.com, book a consultation. Within 60 minutes, I'll give you everything you need to set up your business. Get your business credit profile started, get you registered, get your business classified properly on the federal level with 60 an hour. You're good. Don't worry about it. You can just take notes, man. I got you. No problem. Easy. But, hey, this is part of that stimulus is part of the wealth transfer and not an individual. The individual taking that stimulus, I feel like that's a minimum contact. But sometimes you got to take it. In the meantime, I know most of us are good. We still working. Most of us didn't stop working. Most of us got money. We just don't know what to do with it. We don't really trust people. And I didn't really see an example of my parents, those that I trusted and respected in my community or in my family, a proper and good example of what to do with my money. So I don't know, and I don't trust you. You know what I'm saying? So, the foundation, we just, we here to reestablish the fundamentals and the foundational education with regards to commerce, aka the matrix, here in the United States, corporation that resides in Washington, D.C., with them insular possessions, y'all. But it's all about the family generational wealth. So I appreciate y'all checking out the show. Glitch the Matrix 1. We're going to do Glitch the Matrix 2. I highly recommend that you go to welcometothefoundation.com. At the very least, sign up for the email list. Be putting blasts out. We don't just, be putting... we look to do one at least once a week. But, we fall short. Admin at welcometothefoundation.com. You can book a consultation, inquire with regards to trustee training. I know people have been hitting me up with regards to the foundation. I'm just going to say it on the air. If you haven't been in trustee training or you can't demonstrate trust administration knowledge, know-how, and experience, I don't want to, you got to figure out the foundation some other way. You know what I'm saying? I'm not going to help you get yourself in trouble. That's basically what I'm saying. Straight up. I got enough experience and I'm enough maturity to understand what's good and what's not. So, hey, other than that, I trust y'all have a great week. Enjoy yourself. Don't worry about it. We're going to be straight. Just, pay attention. Understand what's good. I walk with my head up, just in case I need to get out the way of something, And that's all I'm saying. Keep your head up. Pay attention. But don't freak out, yo. Take advantage of this wealth transfer. Get your industry going. Just start. Just begin. Just start. And those of you who are ready to just move and get into this highly technical restructuring and wealth management on the private side, admin at welcometothefoundation.com. How you gonna do? What you gonna do in the stock market? How you gonna buy gold and silver? With what? You gonna buy it with the individual? You gonna buy it with a trust? Private. That's up to you though. Admin at welcometothefoundation.com. Appreciate y'all checking out the show. Make sure y'all say 10 things that you're thankful for before you go to sleep tonight, because that's important. And I understand that you can do it. I got your back. And, let's do this dance. Let's do it together. Don't worry about the boo-hoo. Chugga chugga choo-hoo. Chugga chugga choo-choo. I'll see you at the finish line. Love y'all. Peace to the gods.
Doing this thing all the way live.
High Frequency Radio.